Welcome to this webinar. My name is Ben Frazier. I'm the Chief Investment Officer at Aspen Funds, and I'm going to share with you our latest investment offering called Aspen Industrial Bel Aire. Very excited to walk through this latest offering for our investors. We've been working on this deal for almost a year, getting it ready to bring and present to our investor base, and I'll talk about that in a little bit. But what's so exciting about this deal is this is really a proven blueprint of a strategy that we've already executed on in this market in industrial. And we're going to bring in the same strategy, the same players, the same partners to basically replicate what is already working so well in this market. And the other thing I'm going to talk about too, aside from the deal itself, but if you haven't been investing in industrial or been paying attention to the industrial asset class, I'm going to spend a little bit of time walking through the macro trends of why this is so important for investors to pay attention to and why there's so much excitement about the future of industrial. This is something that we've, again, done in past projects. It's a proven blueprint. We've already talked with a good amount of investors, just getting them interested in what's going on and what we've been working on. And we have a lot of pent up excitement. So we anticipate this is going to be a very successful launch. And so I do encourage you, spend the time to watch the webinar, dig into our data room, look at our underwriting files, look at our slide deck. You can download this presentation I'm going to go through. And if you're interested, if you feel like it might be a fit, be sure to put a soft commitment in the form that we have linked in the data room to secure your spot. So we are going to do a first come, first serve. And because we've had success in our past projects, a lot of those investors are re-upping for this next project. We have a lot of larger check writers that are coming in. So anticipate this to go very quickly and want to make sure you can have a spot. So if you are interested, again, be sure to put that soft reserve in the form so we can be sure to hold a spot for you while you work through the documents. Okay, with that, let's dive right in. Very excited, like I said, to talk about Aspen Industrial Bel Aire. This is an industrial development project in Bel Aire, Kansas, which is a suburb of Wichita, in a market that we believe is poised to be very successful for industrial projects. Real quick before we get into it, got to give the disclaimer. Obviously, this is not a solicitation or sale of securities. You need to review our full private placement memorandum and all the risk factors there within to understand all the dynamics of this project. I will be making forward-looking statements, projections, performance. Those are not guarantees, and you need to understand that past performance is not necessarily indicative of future performance. So with that, let's dive right in. I'm going to go through kind of our management team here pretty quickly because you've likely heard about us. You've seen some webinars. You've seen our background here. But one thing I want to make sure you understand is the kind of key principles we have involved at Aspen Funds working on this project. So Bob Frazier, Jim Mafucci are two co-founders at Aspen Funds over 11 years ago, and really kind of started the approach that we've taken with us over the past decade of identifying macro trends that we believe are in play, likely continue for a period of time, and then use those to create the investment themes and where we think the best places to invest are going to be going forward. And that's definitely how we've come to put together this deal for industrial. You may be less familiar with our partner, Dan Schulte. He's our managing director, chief operating officer. Dan has a very unique background. He's a CPA, an attorney, and was formerly the general counsel at Waddell & Reed, which is a large mutual fund company here in Kansas City, and has been in private equity for over a decade, almost 2 decades now, and has done a lot of development. And so he's actually the lead on this project. He's actually from Wichita, which is where this project is, and has spent a lot of time building our industrial pipeline. And this is a vertical that we really believe in. We're very excited about. And with his experience as a developer in developing past projects with Aspen, even before Aspen, similar type projects, has been a real great key part of this strategy and team. Myself, like I said, I'm the chief investment officer. My background is in banking, underwriting, and capital markets, and do a lot of the underwriting, making sure the deals meet our standards, asset management, and the capital raising as well. On this project, I wanted to highlight some of our partners, right? Because this is really, really key in a development project. It's who you work with is very, very important. And the great thing, like I mentioned before, is we're basically taking a blueprint that has worked really well in the last project that we did in this market, and bringing the same people to kind of bring the dream team back together. So NAI Heartland, it's a full service Kansas City based brokerage. They are really 100% industrial focused. And who we work with, Brent Peterson and his team, you can actually watch an industrial masterclass that we did with him that we actually linked here in the data room, where you can learn more about his background, what they're seeing in the industrial market as, in a general sense. And they're really, really key part of our process, because they help us identify the best places to purchase land, entitle land to build. They give advice based on what the tenants are wanting, what they're seeing in the market, and how to kind of move the projects forward. So they become an invaluable resource in making sure these projects are successful. They help both on the acquisition side as well as the leasing side. And then Crossland. So these are our construction partners. They've been around since the 1970s. I believe they're a fourth or even fifth generation family-owned company, several hundred employees all across the U.S. They're a top construction firm. And when we did the basically interviews for who we wanted to work with on the construction side of things, they were head and shoulders above the rest, in our opinion, of how they execute. They can actually self-perform work if they need to, produce gross max contracts, guaranteed max contracts, and really have been excellent to work with. And the great thing is we've now done a few projects with them. They've been on time, under budget, actually in both projects, and very communicative, great reporting. So they've just been a huge part of driving the success of this and the visibility to get to these completed buildings. They are really good industrial. And so again, really excited to have them as part of this project, and I think going to be a key component of why we believe this is going to be another success. Real quick, you've probably seen this slide a million times. You've been watching us for a while, but how we identify deals, we're looking first at those macro trends. We want to see what is going on in the economy. Where are the opportunities that are being created given those trends, right? There's always good opportunities. You have to look maybe a little bit past the headlines. And a lot of times you have to, skate to where the puck is going to be, right? You don't want to go and do yesterday's deals. You want to go and look forward of where are the supply and demand trends driving the growth, driving the opportunity, and let's go there and let the opportunity meet us there. And that's really how we approach all of our investment opportunities. And this no less, because we really think we're at a really key time in the industrial market and landscape in general, to really take advantage of a unique time. There's been a pretty big pullback of construction, but there is a huge amount of demand and pent-up demand that's building. And we think by the time we're delivering these buildings in this project, it's going to be a really key time. And I'll explain some of those reasons why here in a minute as we get into the macro trends. A little bit of our track record. We've been operating our funds in different assets and deals for over 11 years, multiple asset classes, been at the 5,000 for several years. We manage over $200 million of investor capital, about $500 million in assets under management. And my favorite number there is we've returned over $65 million of distributions back to investors since inception. Okay, let's dive right into the real meat of the presentation on the Bel Aire Industrial project here. So this is a development of Class A, two Class A industrial buildings in Bel Aire, which is one of the strongest submarkets in Wichita, Kansas, which is a secondary market in Kansas, but a really strong manufacturing and industrial market, which I'll talk about here in a little bit of why we like Wichita so much. We're actually already purchased fully entitled land, and now we're going to be building these two Class A buildings, a total of 430,000 square feet. One of the cool things you can see here in the architectural drawings in the bottom right, we have the ability to build up to 5 buildings. And so we really believe this is going to be kind of the first push on this project, but we have the ability to build a lot more. So as we see success in these first 2 buildings, we can basically replicate the model and continue to build out. So we will get some efficiencies and potentially even have some build-to-suit projects that form as we build out this industrial park. This property is in a prime location, like I said, within Wichita. It's got proximity to major international suppliers, easy highway access. And one of the great things in this project is we've already got it, like I said, fully entitled. We also have 100% tax abatement that's already been approved by the city. So it's 100% tax abatement for the first 5 years and a 95% tax abatement for the next 5 years. Well, why is that important? Well, one, it's a big savings on the bottom line, right? We don't have to pay taxes for the first 5 years. But the really cool thing too is it actually creates us to offer more attractive terms to our tenants. What we're doing in these buildings is we're signing generally triple net leases with large, ideally credit tenants. And basically the tenants, sign our lease rate, but they also then take on the responsibility of paying the taxes, the insurance, and the common area maintenance. And when we can, push through the savings of taxes, it actually allows us to get better terms, right? Because there's actually going to be a savings for the tenant. So it's actually a huge value add to this project. And the city, because we've had success in past projects in this market, they've been kind of rolling out the red carpet, really excited about us to continue to help bring the demand or accept the demand that's already trying to come to the market and provide more options for tenants. We're executing a proven business plan. So I'm going to actually share a case study of the last projects that we've done in this market. You can see how well those have gone, what the numbers look like, what our investors are getting from that. And the cool thing too with this project is it's really targeting a 3 to 5 year hold period. So whereas a lot of syndications are longer, they're 5, 7, sometimes even 10. It's nice to blend in not only different asset classes in your portfolio, but also different durations and different targeted timeframes of business plans, right? And so, we have some flexibility there because we want to make sure we can optimize returns for investors in whatever conditions the markets are in. But the goal is to, build, get the tenants in, stabilize, and sell. But then we also have some flexibility on top of that if we need to hold for a little bit longer. And I'll talk about that flexibility here in a minute. What are some key reasons to invest? Why are we so excited about it? Well, first off, there's a lot of demand building for industrial. This is an asset class that, if you haven't been paying attention to, we really believe is poised to go on a second boom here. And I'm going to share some slides of why we think that's the case. Wichita has a strong concentration in manufacturing. It has very low vacancy in the market. Development arbitrage. Development, if you're not familiar with development, and I have a couple slides I'll talk about in a sec of things you want to look at and understanding, how development can actually create a lot more upside, right? If you can build it for cheaper than you can buy it, and if you can mitigate a lot of your risks in building it, you can actually create really strong risk-adjusted returns. So we think there's given our yield on cost, given the stabilized yield we can earn based on building these projects, we think it really compares very, very strongly against other existing asset classes that are, already built. And so I'll talk about that in a minute. Alignment and co-investment, as we share every time, all 4 principals of our Aspen Funds team are investing alongside of our investors in every single deal that we put out for kind of that alignment of interests. In addition, we've already signed the term sheet for the first building's debt, and it is full recourse. So us as Aspen principals are signing on the dotted line to have personal guarantees on the debt for this project, at least for the first building, possibly for the second building as well, depending on what terms we get from the bank. But one, that shows our alignment of interest, and 2, how much we believe in this project and want to stand behind it personally. So wanted to make that clear. Debt's so important in development and really in any type of deal, but it's really important in flexible debt terms. And so we're actually, like I said, we're working with the same construction partners, same broker and leasing. We're also working with the same lender for the first building. And they've been a large regional bank. It's been great to work with on our last project in Wichita. That's gone so well. They want to re-up for the next one. And even though banking and debt is a little bit harder to find right now, there's a lot less competitive terms than there was a couple of years ago. They've offered us some great terms, and they give us some really flexible terms to where we have kind of a 2-year interest-only period to construct the buildings, which we expect to be done well before that. And then we have a 2-year, what's called a mini perm. So it's an automatic conversion to amortizing note for 2 years. So we really have a 4-year maturity window to work through the development and stabilization and sale, or even just to refinance if we have to, which we're doing on another project, which I'll explain. One of the key ways we're mitigating risks on this project is we have a guaranteed maximum contract. So why is this important? Well, Crossland has basically given us a contract that said costs will not exceed X, and we can, take that with a lot of confidence. And in the past projects, like I said, they've actually come in under budget, and so it mitigates a lot of the construction risks that can generally come with construction, right? As we saw, the supply chain issues, hit really hard a couple of years ago, and construction materials, labor, and other things were very difficult to understand, and those risks and the costs that are associated. So that really reduces a lot of risk, right? So it's a key kind of part of why we really get comfortable with this project. And then hold period optionality. So the cool thing with development and developing industrial is we can build these very quickly. So we can generally get these built in about 12 months or less, and can already be working with getting tenants in place ahead of time. And then what we can do is, once we get a stabilized lease in place, we can look to sell the project, or we can refinance it, and we can hold it for a little bit longer and wait till the market kind of improves. And so again, we have a lot of that flexibility, but generally it's going to be in that shorter period of the time frame, between that 3 to 5 year time frame, because the development and construction cycle is so short and compressed relative to, say, multifamily, which can be 2 to 3 years. Okay, proper project highlights. The total budget's about $37 million. We're raising about $13 million. 2 buildings totaling 430,000 square feet. Like I said, it's already been pre-approved. We're, again, really excited. We think the numbers really work really well. And one of the cool things about this is we've mitigated a lot of risk, right? Because we just did a project like this just recently. Our construction partner came in under budget and on time. We just signed a lease with a large credit tenant just a few months ago in this market. So we know what the market is for kind of lease rates. We have very good, strong level of confidence on what we think we can get in this market. And then we also have, again, mitigated the construction costs with a gross mass contract. So we know what it's going to cost to build it. We know what our lease rates are going to be with a high level of confidence. And so we've taken out a lot of the risks in this deal. So we kind of view it as a very de-risked development opportunity. Obviously, there are still risks, right? Timing risk of how long it takes to get a lease signed, et cetera. But again, a lot of those dynamics have been mitigated where we feel very comfortable with it. Construction cost per square foot, we're about a $67 all in with fees and reserves built into that. Very, very competitive, right? And if you're looking at replacement cost, it would be very hard to buy a comparable building for anywhere close to that price. So it's a really, really good all-in cost for the level of product that we're able to deliver, and that allows us to have an untrended yield on cost of about 7.6%. That's likely a little conservative as we're building a lot of reserves and buffer into the budget on that, and also not being aggressive on our lease rate calculations. What we think we're getting right now, even though it'll be really a year plus from now before we're signing leases. These are the numbers based on right now. We think it's very likely to be higher. If you look at trended yield on cost, which take into account some of those considerations, it's well over 8%. So very strong yield. We're targeting a 20 to 25% annualized return over that 3 to 5 year time period. Internal rate of return is between 18 and 23%. Equity multiple between 1.5 and 2.0. That really depends on how long we hold the project for, right? And so that's really where we're targeting on our returns. You can see here, so we have Class A shares, Class B shares. Most investors will be Class A. We'd have a few investors that are writing larger checks. They'll get the Class B shares and basically get a little bit better economics pushed through based on the higher investment amounts. We're targeting, again, that 20 to 25% annualized return, and feel really good about the underwriting on this project. Our debt terms. So, like I said, we already have a signed term sheet, actually a committee approved terms from a bank that we just worked with on the last project, the Iron Horse project. We have a great relationship with them. They loved how the last project went. Excited to sign up for the next one. They've given us a 65% loan to cost. So a pretty conservative leverage, but that's really the market right now for development. But even with that conservative leverage, the returns are still look very, very strong given that the strong yield. Our interest rate is expected to be around 7%. It will get fixed at closing. It's based off a spread on, I believe, SOFR, and right now it's about 7%. And so going to be pretty good interest rate during the construction period that is very competitive relative to other options out there. Like I said, we have a 2-year interest only period, a 2-year mini perm, and it kind of gives us maximum flexibility for how we decide to exit the project or exit the debt. It is also possible that we may utilize some preferred equity in the capital stack, likely be friendly preferred equity to increase the leverage a little bit, depending on the capital markets environment. We have models in the data room that you can see that show all different options, and obviously with the preferred equity, returns get a little bit better because it effectively brings up leverage a little bit. So that's a possibility, that we haven't signed any term sheets yet on that. Why development? So if you're newer to investing in development, why should I consider that? Isn't this super risky? Well, let me walk through a few reasons why development is such a compelling opportunity right now. Well, one, you can see the yields are very strong, and I'll explain why that really matters in a sec. But the other really key thing with industrial is the speed at which you can get from raw ground to completed building and get tenants in place. It's a much shorter cycle generally than multifamily, right? So you can generally be in construction for 2 years, sometimes up to 3 years, depending on the size of the project for multifamily. And then there's going to be another year to 2 of lease up. So it's kind of a long process, right? You're taking on a lot of risk. You're taking a lot of market risk, interest rate risk, construction risk all along the way. Well, you can compress that time frame substantially with industrial because these are much simpler to construct, and we can usually get these done within 12 months and already be having conversations with tenants before the construction is completed. So again, that speed just reduces a lot of the risk because we're not cash flowing for a much longer period of time. So you have a lot less risk when you do that in industrial. Development spread, like I said, we have very strong yield on cost, which is really a key metric you want to look at in development and how that compares to the cap rates. And so it's what we see in industrial right now, especially on this project. It's very strong yields compared to other asset classes. And to me, that communicates value. It communicates reducing a lot of risk and also a lot more potential upside, right? If you can get stronger yield for the same cost, that generally translates to higher returns. And so obviously I'm going to show how that relates here in the next slide. And then flexibility, because we have not only flexibility in our hold period, right, where we can build, get a tenant and sell within a very short time period, or we can build, get a tenant, refinance and hold for a little bit. We have a lot of flexibility on the exit plan, right? But the other piece is we have a lot of flexibility when it comes to how we deliver the product to the market and for our tenants. And one of the great things with how we build these is we're kind of basically building a warm shell, right? Is one way to think about it. And then we are talking with tenants, and then as they basically sign the lease, we can then improve, it's called tenant improvements, the property to their specifications. But the great thing is we can attract kind of the maximum array of options for tenants, whether it's distribution, manufacturing, warehousing. We can appeal to all of them because we're looking at projects that have the kind of full suite of options for those tenants, and then we can kind of build it to their specifications. And so it gives us a lot of optionality when we're trying to sign leases. It's not just a one little thing. It's only going to fit a small section of the market. It can really apply to a lot of different tenants. And then ultimately, our goal is to get one single tenant per building. So we have 430,000 square feet roughly in 2 buildings. We're going to shoot to get 2 tenants, but one of the great things is we can actually demise these into multiple smaller spaces to allow for smaller tenants if we needed to. And there's a lot of demand for that kind of smaller section of the market, kind of the under 100,000 square feet, which I'll show a chart here in a little bit of why that could be compelling. But again, we don't have to do that, but it's another just way that we have optionality and flexibility as we seek to lease this out. Okay, why does yield on cost matter? So if you're new to development, yield on cost might be a new term, right? It's effectively like a cap rate, right? It's your unlevered yield. Cap rate is your unlevered yield that you'll sell at. The yield on cost is basically what is the stabilized return or unlevered yield that my project will generate based on the cost to build it, right? And so why that's important is you want to see a bigger spread between the yield on cost and the cap rate. So the bigger the spread, the more potential for upside, more potential for better returns, and really less risk, right? Because you can withstand a lot of cap rate fluctuations. You can withstand some movement in the underwriting model because you have a lot of margin. So let's go through an example here. Let's compare and contrast an industrial project versus a multifamily project on development and why this is so important. So let's say both projects are a $30 million project. You're getting leverage about 65%. So you're bringing about $10.5 million of equity to both these projects. So identical projects from a cost standpoint. Let's look at what they generate. So yield on cost. This is again, what's the overall yield that the project will generate based on that $30 million of cost that's being spent. Industrial, we're sitting about 7.75%. For multifamily, you're probably lucky to get 6.5 on an untrended basis. Let's look at cap rates. So multifamily will probably sell at a little bit of a premium cap rate, but not that much. And depending on the markets, it might be the same. So let's say cap rates for industrial are 5.75 and multifamily are 5.50. So again, this is all kind of made up numbers, but they're kind of where a lot of the market is at right now. This is really for illustrative purposes. So you can see here the difference in development spread. So this is the difference between yield on cost and cap rate. Well, why does that matter? It's 2% for the industrial, it's 1% for multifamily. Well, what is 1%? How is that going to make much of a difference, right? That doesn't make a very big number. Well, it's a huge, huge number when you apply it to the return on equity. And if you think about, every dollar that you're generating is so accretive to the value because of the multiplicative effect of a cap rate. So let's look at the numbers again here. So stabilized NOI or net operating income is based on the yield on cost. So 7.75% is basically our yield, stabilized yield of 2.3. On the multifamily, because it's lower, it's going to be about 1.95. Well, then the value is based on the cap rate. So then you divide that NOI by the cap rate of 5.75 and 5.50 here. And you can see the multiplicative effect that spread has on return of equity when you apply it across the board. So again, why does that matter? One, I want to kind of break down some of the key metrics you want to look at when you're looking at a development. But two, it's so important to understand when you have margin, when you have these bigger spreads in a project, it creates a lot more potential for upside and also protection for changes in the budget, right? Investment strategy, I've already kind of talked about this, but we're going to construct the first building. We're going to get started ideally next quarter, Q4, and break ground in the first building. We'll probably wait about 3 to 6 months to start the next building. So we usually stagger those a little bit. So when we're delivering them to the market, they're staggered. Construction, again, is expected to take about 12 months or less for each building. We've got a GMAS contract in place. We can really start the conversation with tenants even once construction is started before completed. And so we're going to be having those conversations, working with tenants. And ideally, the goal is to have both of these buildings constructed by the end of 2025 or early 2026. And we'll also be marketing those properties for tenants prior to completion. We built about a 1-year timeframe post-construction to complete a lease-up period, and we have options beyond that if needed. It's very possible, based on the market presence we already have and some of the conversations we've been having with potential interested tenants, is, it's possible that one of the buildings, probably building 2, could potentially turn into a build-to-suit project, right? Which now all of a sudden takes out a huge amount of risk, because you're building the building for a specific tenant. And then again, return of capital. We'll look at the end of, once we stabilize the properties, on either doing a cash out refinance or doing a sale of the project, and we'll determine what we think is in the best interest of investors at that point. Here's a picture of the land. So you can see it's very the horizontal work's already largely been done. A lot of flat space to build up to 5 buildings, and it's in a great location. So you can see here, down in the kind of bottom right of the picture here, this is the development site. It's right by some other manufacturing parks, right by a larger distribution center. There's a proposed very large plant from Integra Technologies that is going about $1.8 billion project going in there, that's being supported by the CHIPS Act. That hasn't been inked yet, but it just shows you some of the momentum that's behind this area of town. So it's really even a better location than our other project, Iron Horse, which I'll show you in a minute how that went. And then it's really conveniently located to multiple highway systems. So you have Highway 254 right here. This is in the northeastern quadrant of Wichita, but that connects to 2 different interstates that connect to basically the rest of the U.S. One is I-135 and I-35, and so you can really get accessibility to anywhere in the country within half a day, a day's drive, or a couple days drive. So really, really key, and a big decision factor when tenants are looking at where they want to be. Here's some of the manufacturing firms. Probably recognize a lot of these names. Again, this is a very heavily concentrated manufacturing market. It's used to be very aerospace kind of primary focus, but it's really expanded and diversified much beyond that, though it still has a great aerospace contingent. Here's the architectural drawings. You can see the kind of 5 buildings we've talked about. For the purpose of this offering, we're just doing the first 2 buildings, but we might do future offerings down the road that will allow construction of the other buildings. Here's an example of completed projects of Crossland that they've done in other projects. Okay, let's talk about demand for industrial. I'm going to go through some of the slides here really quickly. We did a whole masterclass on industrial, and so if you want to go kind of more at length, you can watch that. And I am going to go through some of these slides pretty quickly, because we've done some of this content before, but it's really important to see the story and how it connects to the specific deal. Well, first, you've probably heard the terms nearshoring, reshoring, right? Interest has skyrocketed since COVID, and a lot of the companies are rewriting the whole landscape of their supply chains, of where they want to manufacture certain components of their process. You can see here, reshoring jobs, the announcements for new jobs are up 66% in just the past 2 years. And so there's been a huge resurgence. This is in the US, and there's been a huge resurgence of bringing jobs back to the US that are manufacturing related. You can see the first time that the trend was kind of a decline for many decades of declining manufacturing employment, but it's now actually started to tick up more recently with a lot of these announcements. U.S. factory spending has nearly tripled since 2021. So just in the past 3 years, we've seen a near tripling of dollars being spent for factories just in the U.S. So you can see here it's approaching $220 billion in 2024. And this is not just for the real estate or what we're doing, which is a component of that, but this is for all the equipment, for all the infrastructure, for all the resources, for bringing kind of all these different things back to the U.S. And you can see the chart on the right. This is a chart from Newmark Zimmer. Monumental growth in domestic manufacturing is underway. And so you can see all these circles are basically showing capital that's being spent in these different areas on manufacturing growth. And then you can see the different color shows the different types of manufacturing that are happening in those areas. Energy prices and energy security is causing a lot of European manufacturers to shift to the U.S., right? Europe is not energy independent. And so they're looking for security in that, right? And COVID kind of exposed a lot of weakness for the European manufacturers. In the U.S., we're energy independent, right? We are the largest producer of oil in the world. And it's a key component of manufacturing, right? It takes a lot of energy to manufacture, and so it's usually one of the more expensive line items for these companies. And so having confidence, having security in that is really, really important. This is a report from BlackRock's 2024 Private Market Outlooks. They identified logistics hubs near major cities, which is exactly kind of what Wichita is, as one of the top 3 areas to outperform in 2024. And we have more data to support that's definitely the case. So you can see here, this is construction start. So this is new projects that are being started in industrial. So we saw a big boom in 2021 and 2022, somewhat similar to multifamily, right? But then we've seen a significant drop-off, significant decline in construction starts. And what was mostly built in those couple year period were very large properties. So these were the kind of Amazon, the FedEx type facilities that are the million square feet properties. And so you can see over 25% of all things that were built were over 500,000 square feet. But if you look at the demand and where the biggest vacancy and opportunity is these are vacancy rates for still near all-time lows for properties smaller than 100,000 square feet. So that kind of smaller segment of the market, there's a huge amount of demand. And that's part of the reason why we're building this in 5 separate buildings, right? Versus one large one, is it's going to create a lot more momentum and an option set for tenants that otherwise, wouldn't be able to take down some of those larger spaces. This is a really great chart from Newmark Zimmer. They just published this literally a few weeks ago. They're basically projecting that supply and demand gap will narrow substantially over the next 12 months. So you can see here, the blue line are the deliveries. So we've seen a big, at the end of 2022, a large amount of deliveries, but it's fallen off significantly on new projects that are being brought to the market, right? And then demand is really started to tick up this year, and they're expecting that kind of cross the threshold in 2025, where demand is now outpacing supply like we've had in past years. And so here's some of their predictions for the U.S. market, and this is over the next year or two. They're saying that the global shifts in supply chains are going to continue. This is something that's not a new trend. It's not a short-term trend. It's a long-term mega trend of rewriting the whole supply chain of the world. Absorption in secondary and tertiary markets will continue to outpace primary markets because they become very attractive for these tenants when they can find good blue-collar workforces, and they can still get access to most markets, but at a much cheaper cost. And so that's Wichita fits very squarely in that, right? That this is going to be a great market that they're predicting will outpace primary markets. A lot of the land has been purchased, but a lot of developers have stopped developing right now. And so it's going to have a constricting effect on the industrial pipeline that's going to be delivered, because it's hard to get really good land in prime locations. And if you have good spots and you're developing on them, then you're going to be one of the only players in town come fast forward to 12 months from now, when demand is really ticked back up. And they're expecting demand to consistently outpace supply in 2025. And so right as we're delivering this kind of these buildings at the end of 2025, they're really expected to, we believe, to be at a great time in the market when the tenants are, looking for buildings just like ours. So Wichita, why is this a good market? Well, one, we've had great success here in past projects. But one of the great things, and why this fits so well into the story of the reshoring trend, is looking at manufacturing. They want to look for a good workforce, good blue collar workforce that has a strong manufacturing contingent, that's not going to be super expensive like you see on the coast. And so Wichita is actually the number 4 most skilled manufacturing workforce in the nation. So it's ranked in the top 5 of one of the best manufacturing workforce in the nation. Number 1 for percentage of jobs classified as high tech. There's a lot of actually tech happening in this market. And then nearly 15% of all employees in Wichita work in manufacturing. So it's a, again, very heavily manufacturing focused market. So it's going to continue to attract those tenants that need to find a good manufacturing workforce. It's got some great hub for all these different types of manufacturing, great accessibility, the railways, a lot of highway access, and it's a pretty good sized population down in Wichita there. Here's some of the major companies. You've probably seen a lot of these names that have a very large presence in this market, a very large manufacturing ecosystem. Again, that's been around for many decades. Okay, I'm going to show you a example of the project that we just completed called Iron Horse. So we started this Q1 of last year, 2023. Purchased the land, we began construction. Called Iron Horse Industrial Park. This project was also 2 buildings, about 330,000 square feet. So we started the first building, we completed in less than 12 months. Building 2 was started about 4 months later and completed that in 12 months. Our construction partners, like I said, Crossland, came in under budget on both buildings. And we have now just signed a triple net lease from a credit tenant, publicly traded company. On building 1 and building 2, we just delivered a few months ago and have several LOIs for interested parties. So a lot of momentum on the leasing front. We just signed leases above pro forma rate, and timelines and our budgets have exceeded and beat our pro forma. And so the intention was similar to this project, where we're looking at multiple options. Do we sell, or do we do a refinance and hold for a little bit longer? Well, right now is not a great time to sell, right, as most people understand. And so we evaluated the potential of that. But then we started evaluating what permanent debt products looked like. And so despite the much higher interest rates that are 5% higher than they were when we started this project, and the lower leverage ratios that lenders are putting out on stabilized projects, we're actually still expected to return capital, partial capital, back to investors and continue to cash flow until we dispose of the asset, probably a couple of years down the road as the market improves. So again, that flexibility I was talking about, we have that ultimate option set to figure out what's the best approach based on where the market's at. Well, with the new debt we're getting on the building 1, it's only gonna be a 65% LTV. That's kind of the market right now. But even at that lower LTV, we're expecting to send back about 25 to 30% of capital allocated to that first building back to investors. And we can cash flow on a triple net lease with the credit tenant. And you can look at some of the numbers here. We are all in cost for construction. We're about $16 million. Current estimated value is about $21 million right now. We expect that to increase over the next couple of years as inflation and some of the rent escalations in this lease get increase, and as the market continues to improve. So based on that current estimated value, this is not a guarantee return, but the unrealized equity gain that our investors have received on this building is about 61% in about an 18-month time period. So you can see, why this is such a compelling story here is we hit our timelines, beat our pro forma on lease rates. We're actually able to return capital back in this market, right? That's pretty rare. Most of the refinances I hear about right now are cash in refinances. We actually have to send money to the lender to pay them off versus actually get money from a lender as additional cash out. And so that's pretty awesome. You can see some pictures here. They're I think pretty good looking buildings, industrial buildings, right? And let's get into the actual investment summary here, and we're going to round it out here with kind of a few more slides. This is a broker opinion of value. So we purchased the land just a few months ago, but we actually were under contract for over 9 months. And when we purchased it, it was not entitled, had not had the tax abatement done. So we purchased it at about a $2.99 million purchase price. But because we were able to have that length of time of the contract to get the entitlements, to get the tax abatements approved, all of a sudden the value of the land has increased substantially. So we're actually not marking up the land in this project. We're bringing it in at cost of $3 million. But the broker is saying that the value right now is somewhere around $6 million if we wanted to sell just the land. So obviously it's not the plan, but wanted to show kind of the value that we've already created just through doing the work ahead of time to bring it to this point. And that's going to be a value add that our investors get to participate in this project. So here's some of the return summaries. This is from our underwriting models. These are in our data room. You can review these, take a look at these. Already kind of talked about some of the range of returns here. Of a cap rate sensitivity, you can kind of see what the return profile looks like based on different cap rates in the market, on what they can be a couple of years from now. Here's our overall budget and kind of what we're expecting costs to be and lease rates to be. Here's a kind of cash flow pro forma. And so obviously no cash flow in the first year. We have a kind of a partial cash flow year 2 from getting the buildings partially leased. And then kind of year 3 is stabilized cash flow. Tax benefits. So this investment, we're not anticipating large losses in 2024 as we'll just be starting construction. But there'll probably be a little bit of some tax write-offs from the expenses that we generate in the project in 2024. Our plan again is to start building 1 this year. And then we do expect to generate passive losses in 2025 as we kind of complete the construction. We'll likely do a cost segregation analysis to accelerate that bonus depreciation for investors. And then ultimately at the end of the day, when we sell this project, most of the profit and gains will likely be classified as long-term capital gains to make it much more tax efficient. So again, we're trying to make this as tax friendly as possible, and we'll be optimizing that for our investors. Okay, with that, if you're interested in this deal, definitely encourage you, like I said at the beginning, to put your soft commitment in the data room here. We have a form for you to fill out. We've already received a lot of just indications of interest even before the deal is launched. So we anticipate that to get filled up very quickly because we also have several larger check writers that are coming in to the project. So be sure to submit your soft commitment amount and someone from our team will reach out to you to share with you the next steps. And if you have any questions at all, please don't hesitate to reach out. We're happy to address all those questions. You can see the email there or the phone number. And if this seems like a good fit for you, we encourage you to put that soft commitment in while you were finishing reviewing the project, so we make sure we got a spot for you. And again, appreciate you watching this webinar, and hope to see you on the other side. This project seems to be a fit for your investment portfolio. Thanks so much. Awesome. All right, guys. Well, hopefully that was very informative. And see some questions here in the comments. We're going to do live Q&A right now. So if you have questions that you don't feel like were answered, please put those in the chat right now, and we'll get those answered right away. So seeing some comments here. Great questions. Hello, everybody. Good to see you. And okay, first one. So would potential future builds be new raises, projects, or potential upside in this investment? So the way we've structured this is the land is being parceled out. So we can parcel into 5 different projects. And so the first 2 we're taking down on this project. It will likely be future raises that we will be making for the new development. So obviously we would give first kind of right and access to current investors in this project to participate in the next ones. It's possible that we may step up the land basis slightly because of improvements. Like I said earlier, we're not stepping up the basis, even though we've likely increased the value by almost double on the land from entitling it and getting the tax abatements. We may decide to do some type of step up to reward kind of earlier investors, which would be very fair. So that's kind of how we plan to do it. They're separately parceled. We can separately finance them, separately raise equity. We anticipate some of these may turn into build-to-suits. So that would be kind of a whole different risk profile and potentially different financing for that. So great question. What's the next one we got here? Well, costs will be done in 2024. What is the anticipated depreciation for investors? I hit this at the very end, so that's probably answered for you. But just to clarify, in 2024, right, you can't depreciate land So we've purchased the land, and then starting Q4, we're going to be making the improvements, starting the construction. So there will likely be losses from construction expenses in 2024. And then the majority of the tax benefit is going to come in 2025 through all the construction expenses. And then we will likely do a cost segregation in 2025 because of the improvements that we've made. We can now depreciate and accelerate some of that depreciation for investors. And then the great thing with this investment, right, is most of the returns are going to be considered long-term capital gains when we sell, and that's obviously taxed more favorably than ordinary income. So it's a fairly tax-efficient way to generate, some nice returns along the way. Okay, next one, Cameron. He's got all the good questions, man. Keep them coming. What types of industrial tenants are expected to occupy the buildings, whether it be offices or warehouses? How many tenants per building? Was labor pool education available in the market? I think I covered a lot of this. So the way that we build these buildings is as what we call like a warm shell. And effectively that allows us to attract the broadest segment of tenants as possible, because we can really go a myriad of directions. We can go to the more warehousing, heavy office, or more distribution with the cross docking, or manufacturing, light to heavy manufacturing. So we have the ability to meet the needs of all of those types of clients, which is why this works so well, is we can build it to kind of the lowest common denominator, and then we will do the tenant improvements based on the needs of that tenant. And the great thing with those is those are generally financed at a much higher leverage point with a bank, and so we kind of build in estimations of kind of a conservative amount of what we think those tenant improvement allowances would be, but generally the banks come in at a much higher percentage to cover those improvements and bring the overall leverage up a little bit. From the bank standpoint, obviously the risk has been reduced. Now you've got a tenant in place that they can use to underwrite the cash flow. As far as the labor pool, I already hit this on Wichita. It's an incredible labor market for these types of tenants. And if you looked at a lot of those charts I showed in the demand drivers for manufacturing, it's really moving to the Midwest, and really the things they're looking for are, one, cheaper rent, access to most of the country through distribution and good interstate systems. And then the other big piece is labor, right? They want cheap labor to compete against the overseas labor. And that's what Wichita provides, which is why it's such a great secondary market. And obviously Newmark's expectation that secondary markets will outpace primary markets due to those reasons. Great question. John Wyckoff, thanks for chiming in. What was the ROI for investors on your last project in Wichita? So I went through that, and you can see right now we're sitting at about a 61% unrealized gain on as-is value right now. So we're deciding to hold that project. We could sell and probably get close to that number, but we feel like there's more upside because we outperformed on the lease rate that we underwrote to, and our cost basis was locked in. And so we have a nice margin. We have some really good rent escalations built into that lease. And we also believe with interest rates kind of on the decline, as most people expect, that will improve capital markets, and we can actually potentially chase a higher price, higher valuation a year or so down the road. So that's the decision we're making. We're returning cash back to investors tax-free, right, through a refinance. So that's great. And then, from an unrealized standpoint, we generated, roughly 60% in 18 months of this unrealized, not realized, but we expect that to likely grow as inflation kicks in, as capital markets improve. And we have appraisals to verify all those numbers that I'm sharing. Do we qualify to get funding under the CHIPS Act? Great question. So we don't. So the CHIPS Act is really intended for manufacturing companies of semiconductors and other chip-related manufacturing. So it's not really for development or real estate opportunities. It's more for the manufacturer of those pieces of the semiconductors and those kind of plants. So not for us, but again, that will drive a lot of the demand. So where these companies come, a lot of times if it's a big company, right, like the Integra plant we talked about, this right next to this project, $1.8 billion project, because of that CHIPS funding, that's allowing them to make those investments, and that creates kind of secondary demand around it, right? So other suppliers to them, it brings kind of a magnetic approach to that market based on those decisions being made by the manufacturers. Okay. How many similar projects and stages in Wichita market? Was a project competitive advantage to the projects? Great question, David. So obviously we've have two other projects in Wichita. One that I mentioned has already been leased. The other one we're in late stage negotiations for potential other tenants to lease that one up. And that's actually driving a lot of the demand for Bel Aire, because some of those conversations have turned into well, what if we do a build to suit, right? And so we don't have anything inked up right now, but we anticipate it's very, very possible that one of the buildings, likely building 2, becomes a build to suit. And if not that, probably future ones. But we've seen a lot of demand. There's a lot of interest in this market. There's not a lot of vacancy in the market, and so there's not a lot of options, especially in the Class A kind of 32-foot clear height buildings that we have that are the nice buildings that these types of tenants want. Competitive advantage or disadvantages to those other projects. It's like I said before, it's very similar. We're bringing kind of the same, A team to this project. This works so well. And, the one I would say competitive advantage we actually have in this new project in Bel Aire is location. So if you know Wichita at all, look kind of the northeastern quadrant. Wichita is kind of made up of 4 quadrants. The northeastern is the kind of nicest part of town, the most development, most activity happening, and where we're able to lock down this land is a very, very prime location. And so we believe location is actually a much more appealing location than the other ones. And then, past projects that we've done, our lead developer, Dan Schulte, one of our partners, he's done a lot of other development in Wichita and has run successful projects through development and has actually made them, turned them into REITs, has successfully raised the capital, returned capital, and gone full cycle on those. So a lot of experience in the market. Since inception, have any investors in Aspen ever lost money? Thankfully, no. The answer to that is a emphatic no. Our investors have never lost money investing in any of our funds. Will the accounting of this fund be audited by a third party? They will not. Given the size of the project, we don't generally do it unless the fund is, anywhere from a probably $40 to $50 million fund is kind of the bright line. Just from the size of the project and the cost of an audit, doesn't usually make sense. But our other funds are audited, larger funds. But we will provide financials on a quarterly basis, so you will have clear visibility into everything that's going on, and can always ask any questions related to that as you have. Okay, what percent of range do you amount the depreciation could be? It's a little hard to say. Obviously, this year is going to be a smaller amount as we're just starting the building 1 in the first quarter. So it takes, again, about 9 to 12 months to construct. So a smaller portion in 2024. If you look at 2025, the estimated kind of based on the estimated costs that we have, we can run some analysis. That's actually a good question. We'll have our team talk with our CPAs to see if they can give us a range on depreciation. Obviously, bonus depreciation goes down potentially next year, but it still likely will be very good, given the one will have losses that will have generated through construction. Like there's likely no income coming until the end of 2025 at the earliest, and then we'll also be able to accelerate the additional improvements that we've made to the property. When Aspen sells this, we'll also have another fund that will be available for investors to 1031 exchange into. We can't confidently say yes, but that would definitely be something we would explore. Obviously, that's beneficial to everybody, and we would definitely look to do that. We have a very, very large pipeline of industrial deals that we're continuing to build out the strategy for the reasons that I shared earlier, why we're so bullish on this vertical. We think it's going to be a decades-long trend that we're going to be a good sized player in. So the likelihood that we'll have something else that we can 1031 into will, I would say, be high, and we'll definitely look to do that if possible. What is our skin in the game? And is this webinar recorded? So this is live right now. The previous portion was recorded. And skin in the game is, we're going to be investing. It's not determined yet, but probably somewhere between $400,000 and $500,000 from principals. All right, go to the next one. Who are the general partners and the percent of the GP? So the only general partners of this deal are Aspen Funds partners. We have no other GPs in this deal. So it's 100% between our 4 partners. The debt is recourse to the GP. That is correct, and not to the LP. So the LP has no recourse, right? If, God forbid, something goes wrong and the bank has to go collect, they go to our personal guarantees, not to the entity, which would have the only asset they would have is the building, obviously, but personal liability is limited to the partners, which is why it's called limited partners, and general partners is we're signing on those guarantees with our own balance sheets. So great questions, guys. Ross just threw in a last minute question here. Mr. Driller, what was the ROI in your last project in Wichita? I shared that, and we'll have likely a case study we'll put out here probably early next week. But it's in the presentation. We'll have this recording sent out later today on that. So we were in about an 18-month time period have a 60% unrealized gain profit to investors, 18-month time period. It's unrealized because we're not selling right now. We are returning about 25% of capital back to investors tax-free through a cash-out refinance. And the remaining is considered unrealized until we sell. But we expect that to likely go up as we have rent escalations built in to our leases, and as the capital markets improve with interest rates coming down. So as we sit right now, current assets value about 60% in about an 18-month time period. Okay. All right, guys. Well, with that, I think that's the last questions we've got. Thank you so much for joining. I know this was a little bit long, but I'm going to throw up here on the screen a soft commit QR code. So, and then we also put that link into the chat so people can just click on a link if they don't have their phone. This is a link to soft commit. So the way that we work a lot of these deals is we'll get soft commitments. You don't have to, sign the dotted line with a legal document, but this is just to give us an idea of interest, and we go first come, first serve, right? So we've already got a few larger investors that have indicated they want to invest in this project alongside of us, and expect, a decent amount of soft commits to come in today and tomorrow and over the weekend. So, if you want to reserve your spot online, please go to this link and put your soft commitment in, and we'll be sending out legal documents. They should be ready early next week to send out to review, but we'll have all of this webinar recorded, our underwriting files, the slide deck, and several other supplementary information for you to review. We'll be sending out the data room later today, so you can watch this recording again if you like, review the other information, the underwriting models, etc. So go ahead and do a soft commit if you're interested, so you can reserve a spot, and we'll follow up with you from there and confirm that up as you review. So with that, thank you so much for watching. Really appreciate you to spend the time watching this presentation, and hopefully you see the merits of the deal and why we're so excited about it. So have a great day and a great holiday weekend. And before you have too much fun, if you're interested in the deal, be sure to put your soft commitment in. Thanks so much.